Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic expenses and income. In this question, we will prepare the ledger accounts for an expense and also an income, and then we will discuss the accounting theory which justifies the recording of expenses incurred and income earned in a given financial period. You can see the question on the left hand side of your screen, and on the right hand side we have got all the workings which I'll explain step by step. So with that being said, let's begin. Jonathan is a sole trader with the financial year end on 30 June. The following information has been provided by him as at 30 June 2020. So we are given the account balances at 1 July 2019, which are the opening balances, and we are given the opening balances for wages payable and rent income receivable. When we think of wages payable, it is a current liability because it is a present obligation for expenses that we have incurred in the previous financial year, right, ending 30 June 2018, okay? And then we have got rent income receivable of $1,080. So receivable here refers to the business expecting economic benefits in the future. Therefore, it is a current asset, all right? Now, you are also given some extra information with regards to cash inflows and outflows. During the year ended 30 June 2020, we are given the payment made for wages, which is $48,600, and then we are given the rent received of $8,750. Now, how can we journalize these two transactions that happened during the year ended 30 June 2020? So when we think of payment made for wages, we understand that we are spending money. So there is an outflow of funds from the business, right? So these funds are taken from the bank account, which is an asset account. We know that assets, when they increase, we debit them. Now that we are paying for wages, our balance in the bank account is decreasing. Therefore, our assets are decreasing. And when assets decrease, we credit them. So we will credit the cash at bank account by $48,600. And simultaneously, we will debit the wages expense account by $48,600 because we have made this payment relevant to wages, okay? Then we have got the rent received during the year ended 30 June 2020, and that is $8,750. So when we are receiving rent, we are receiving money in our bank account. So that means our assets are increasing in value, which means when assets increase, we'll now debit it. So we debit the cash at bank account by $8,750, and simultaneously these funds were received for rent income, right? So we credit the rent income account by $8,750 because when we have income in our business, we always credit them. Similar to how we credit the sales revenue every time we have got revenues in our business, okay? Now the requirement in part A is to calculate the amounts for wages expense and rent income, which we will show in the statement of financial performance, also known as the income statement, for the year ended 30 June 2020. And we are going to achieve this by preparing a ledger account. So let's start with wages expense. So here you can see the ledger account for wages expense already prepared in the usual 5-column format that we're used to, with date being in the first column, followed by the cross-reference for accounts, which are the particulars column, and then we have got the debit and the credit columns, and lastly the balance column, okay? So we know the beginning of the period on 1 July 2019, we have a wages payable, which is a current liability, right? So all liabilities by default must have an opening balance that goes on the credit side, because liabilities, when they increase, we credit them. So wages payable, $2,500, is included in the credit column, which gives us a net balance of $2,500 credit, okay? Then, during the year ended 30 June 2020, if you recall, we have made payment for wages, right? And when we made the payment for wages here, when we journalized it, we debited the wages expense account by $48,600. So that is what we are to reflect in the ledger account for the year ended 30 June 2020. In the wages expense ledger account, all right, we are going to show $48,600 on the debit side based on the journal entry, as you can see, and the relevant cross-reference for the account we will show in the particulars column is the cash at bank account, as you can see in the journal entry, right? So $48,600 debit, and we have a net balance of $2,500 credit from the previous transaction. So which means we have more debits than credits. So what we have to do is now offset the previous $2,500 credit and ultimately end up with a net balance which is debit. So that means we will subtract $48,600 and $2,500. So that gives us $46,100 with more debits, because obviously our debits are higher than credits, okay? Now, let's look into the additional information. Number one, an amount of $1,750 of wages payment for June 2020, which is the last month of the end of the financial year that we're working with, was still outstanding on 30 June 2020. So what it is saying is that we have incurred an expense of $1,750 for wages, but we still have not paid for it at the end of the year. Therefore, it is now a current liability, right? So at 30 June 2020, we have got some current liability for wages which are yet to be paid, and that relevant cross-reference for account we will use is the wages payable account, okay? So when we move to the next financial year, which would be on 1 July 2020, right? We have a new wages payable, and as we have already discussed at the beginning of this ledger account, all liabilities must have an opening balance on the credit side, which also means that when they increase, we credit them. So that is why we show the opening balance on 1 July 2020, the beginning of the next financial year, to be $1,750 credit, and it is a credit balance because it is a liability. And this is the nature of liabilities, to have a credit balance by default, all right? So what that means is that we want to end the financial year, 30 June 2020, with a net balance of $1,750 credit, okay? So this is the map or the process we will follow to correctly prepare the ledger account every time. So we want to end up with a net balance of $1,750 credit. And our job from this ledger account is to calculate the wages expense amount, which we will show in the statement of financial performance or the income statement, right? So this thing is the amount, the missing figure, which we are deriving, that goes in the statement of financial performance. So at 30 June 2020, to go from $46,100 debit to $1,750 credit as the final balance, what do we have to do? We have to bring $47,850 in the credit column. And how did we achieve that? So you see, previously we had a balance of $46,100 debit, and we want to end up with a net balance of $750 credit, which means we need to add these two numbers and include it in the credit column, because when we include $47,850 in the credit column, what that does is first offsets the entire debit totals we had before and then leaves us with the surplus amount of $750 credit. Does that make sense? And that amount is what we transfer to the statement of financial performance using the account income summary in the particulars column. Okay, so this $47,850 is the actual wages expense which we are closing at the end of the financial year. So here we are preparing a closing entry, and that is why this amount is being shown on the credit side. And why are we preparing a closing entry? Because expense accounts are temporary in nature, which means at the end of the year we must close them so that we can start the next financial period with a zero balance for the expense itself. Okay. So when we are closing it at 30 June 2020, we will debit the income summary account by $47,850 and simultaneously credit the wages expense account by $47,850, because we understand expenses by default in nature are debited, which means when we close them or when we reduce them, we have to credit it as part of transferring it to the profit and loss statement. Okay, so that's what's going on here. So wages expense is $47,850 that we have derived from this ledger account. Now let's look into the rent income account. So here we have got the rent income account, again prepared using the usual 5-column format, with date being in the first column, followed by the particulars column. You can also write details, the same thing. Then we have got debits and credit columns. And then lastly, we have got the final balance column. So to begin the financial year, on 1 July 2019, we are starting with rent income receivable, which refers to an economic benefit that we expect to receive in the future from our tenants and therefore is a current asset. And all assets by default must have an opening balance on the debit side, which also means when they increase, we debit them. So rent income receivable is shown on 1 July 2019 on the debit side, which then gives us a net balance of $1,080 debit. Then during the year ended 30 June 2020, based on the additional information number 2, not the additional information number 2, based on this information. So we understand we have received rent of $8,750. And we previously looked into the journal entry. When we receive rent, the balance available in our bank account goes up. So we debit the cash bank account and we credit the rent income account. So this means the rent income ledger account will now be credited by $8,750 with the relevant cross-reference in the particulars column being the cash at bank account. So here you can see for rent income, so we are including $8,750 on the credit side because obviously it's an income at 30 June 2020 with the relevant cross-reference in the particulars column being the cash at bank account. So we have got $8,750 credit, and previously we had a net balance of $1,080 debit, which means we have a mismatch, and obviously we have more credits than debits, so we will subtract the two numbers from each other, and then we get $7,670 with a net balance of credit, obviously because we have more credits than debits. Now, we know, based on additional information number 2, included in the rent income received was a sum of $730 in respect of July 2020. So this money of $730 we have received in advance, which is basically going to be earned in the next financial period, which is the next month, July 2020. So what that means is that when we move to the next financial period on 1 July 2020 and we want to show the opening balance, we want to show it as a current liability by including the account for rent income received in advance, which is a current liability account because we haven't earned the rent income. We just received the money in advance from our tenant. We will only earn this income after the entire month of July 2020, the next financial period has passed. And once we have fulfilled our obligation towards the tenant to let them stay in that place, right? So because we have a current liability as an opening balance on 1 July 2020, and as we have previously discussed, all liabilities must have an opening balance on the credit side. So we are showing $730 credit as the net balance, which means we must end the previous financial year, 30 June 2020, with a net balance of $730 credit. So how can we go from $7,670 credit to $730 credit? We just simply find the difference, which is what we include in the debit column. So that is $6,940, right? At 30 June 2020, the amount which is transferred to the statement of financial performance using the income summary account as part of our closing entry, okay? So the rent income that we have actually earned for the year ending 30 June 2020 is $6,940. So this is the amount you'll be including in the statement of financial performance as rent income that has actually been earned, okay? Now, let's move to part B. Explain the accounting theory applied when calculating the amount of wages, expense, and rent income for the year ended 30 June 2020. So we are simply using the accrual theory, which states that revenue and income should be recorded as they are earned, not necessarily when cash is received, okay? As you can see, for the opening balance at 1 July 2019, we have got rent income receivable of $1,080. This income was already earned in the year 2018, 30 June 2019, right? This income was already earned, but we didn't receive the cash. So that was still included as part of our income in that year. And then we have got expenses which are recorded as their income, not necessarily when cash is paid, which is what you have seen in this transaction. For additional information, number 1, where we have $750 of wages for the month of June 2020, which is an expense we have incurred, but it was still outstanding, which means we haven't paid yet. So that is what we are referring to as expenses, which are recorded as incurred, not necessarily when cash is paid. All right. So now let's move to part C. Identify two stakeholders other than the owner, Jonathan, who would be interested in the financial statement of Jonathan's business. First of all, of course, the government, because they want to look into the financial statements for reporting purposes regarding the country's businesses. And also, it's mainly for tax purposes. The government wants to know how much you owe them in taxes based on the profit you make, all right? Then we can also have our suppliers with whom we want to enter into arrangements for bulk credit purchases. And therefore, these suppliers, they would assess your financial statements to mainly look whether you have sufficient cash to pay them off in the short run, all right? So you could talk about these two stakeholders. You could also talk about the lenders, such as the bank. For instance, if you want to finance your operations and grow your business and you need additional capital, you could opt to go to the bank, who would be interested in knowing how you have been doing since you have started your business, right? And based on your financials, they would decide whether or not they will give you the loan and the relevant interest rate that they're going to charge you. So many stakeholders you could talk about, as we have discussed, three of them: government, suppliers, and the bank or lenders. All right. Okay, so that's all for today's lesson. I believe you found value in this content. Make sure to drop a like and subscribe to this channel, and check out our programs which we are running for next year. And I'll see you in the next lesson.